Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange. I'm Jared Blickery, your host, and with me, as always, is the voice of the people, Sydney Freed. And while we have your attention, please like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming Stephanie Roth, who is the chief economist with Wolfe Research. Hello. And today we're going to be focusing on the economy, and we've got some fresh inflation and jobs data to key in on. Our word of the day is tariffs. Are they simply a tax? We provide some context and nuance. And this episode is brought to you by the number 3.93%. That's where the bond market sees the 10-year falling to by December, and we've got a long ways to go to make that all true. Why all this wonky bond stuff matters. And before we get to our word of the day, we want to ask you, Stephanie, how is 2025 shaping up for you so far?
It's shaping up to be a pretty good year. We're looking for trend growth in terms of the economy to be above the typical trend. Something like 2.2% is kind of how we're thinking for GDP. Generally speaking, the trend for this economy is somewhere around 2 or slightly below. Over the past couple of years, it's been very much above trend.
Yes.
So should be a decent year. Inflation might be a little bit sticky, but nothing that should be overly concerning, nothing that's picking up really either.
Yeah, and we'll get to inflation in a minute. Want to get to our word of the day, which is tariffs. And here's the definition. A tariff, if you didn't know already, is a tax or duty imposed by a government on imported or exported goods. And it's often used to protect domestic industries or to generate revenue. And at one time, it was a major revenue generator. And I went through some history. The first tariff in the United States was a Tariff Act of 1789. Then it goes on some other major ones. We had one in 1828. We had one, the Smoot-Hawley. Bueller, anyone? Bueller. Smoot-Hawley was in 1930. We had the Trade Expansion Act of 1962. And then we had the Trump tariffs of 2018. So we've seen these kind of rear their heads. And this is very much a different context today. So what do the tariffs mean to you? How should we be thinking about them? We're thinking about them too much.
No, the tariffs could be really impactful. Tariffs, in my opinion, are a stagflationary type of shock on the economy, which means negative for growth and positive for inflation, which is the exact opposite of what the Fed would like to see. The thing is, our base case is that we're not going to see big tariff policy until later this year, which is why I earlier mentioned we're pretty optimistic on growth this year. If you were to tell me Trump's broad-reaching tariffs were going to happen on day one of his administration, I would be a lot more negative on the economy for this year. So base cases, they happen later in the year, but it's something that we should absolutely be focused on because this is a tax on the consumer, and it's a really big headwind to the economy in 2026.
I want to key in on that tax for the consumer. So what do they end up paying that they wouldn't have without tariffs? Is it like a couple dollars? Is it significant? Well, I guess a couple dollars is significant, but how do they actually see that?
Do we even know?
So here's the transmission mechanism to the consumer, and then rough estimates in terms of how much it could cost consumers in aggregate. So the way it gets passed on to the consumer is the importer has to pay the tariff rate to the U.S. government. They're going to try to sort of pass that along the supply chain. So they're going to raise their prices to the buyer, and then the buyer would be, let's just say, a regular retailer will try to raise their prices, hoping that the consumer will pay. Exactly, hoping that the consumer will pay for it. So at some point, the consumer will ultimately feel the headwind on this kind of along the way. Now, estimates in terms of how much this could cost the consumer, there have been a wide range of estimates. Our numbers suggest it could cost households well over $1,000 if we get even a modified agenda in terms of what Trump has proposed.
What we saw in the first Trump administration was there was volatility that surrounded the tariffs, and that kind of became its own thing. So if we set aside the dollar impact of the tariffs, just kind of the tool of tariffs and maybe the threat thereof, any thinking along the volatility that maybe brings to the markets or the economy?
Yeah, it certainly does bring quite a bit of volatility. We saw that very much in 2018, and I would expect to see that again, especially since Trump is likely to play a bit of a negotiation game with a lot of these other countries. And in doing so, that's going to create a lot of volatility because this affects company earnings. So that's why it brings volatility to markets, because it has a real effect in terms of how companies are valued to some extent. So we should expect to see a lot of this negotiation tactic. And once the market actually believes that these tariffs are going to happen and has a sense of what the policy might actually be,
sure,
that's when we should start to see that volatility pick up.
So tariffs are inflationary, correct? What else is potentially inflationary that you're seeing in the Trump trade?
I would say tariffs are the biggest thing. The other thing is the fact that growth might just be a little bit better than would otherwise be the case.
Even the Fed bumped up their growth estimate for the 2025, I think, in the last meeting.
Yes.
So 2.5% from 2%, something like that.
Yeah, so the outlook for the economy is a bit better, at least for now. And the key reason is that companies are feeling better about the backdrop, and they're wanting to invest, this whole animal spirits concept. And it seems to be real. You're starting to see measures of sentiment start to pick up, and that actually has a self-fulfilling effect on the economy. So that could help to boost growth. And then deregulation is another one that could help to boost the economy. As for the inflationary impact, if you just have better growth, and that could be inflationary. And then, of course, there's immigration. Immigration is the
big wild card too.
That's a big wild card, and something that is likely to be at least modestly inflationary for the economy. If Trump actually does a lot of what he said, which is cutting off a lot of these programs that the Biden administration put in place, we could see a massive slowdown in the flow of immigration, which has been helping to support the strong labor market that we've seen.
What about, and Trump is inheriting a big fiscal deficit, a current account deficit. So that speaks as to the trade situation of the U.S. And then on the other side of the fiscal house, we have Scott Bessent coming in, and assuming that he's confirmed, he has pledged to reduce the average weighted maturity of the U.S. debt profile. So the U.S. has been selling a lot of short-term bills and has been issuing debt in short-term bills. The problem is those have to be rolled over. A lot of those are coming due, and the U.S. the new administration wants to get into longer-term debt to lock in maybe some lower rates or just to protect. Can you talk about those dynamics?
Yeah, so the problem is that could start to put upward pressure on the longer end of the yield curve. So higher bonds, called the 10-year bond, could start to rise, which is exactly the opposite of what the Trump administration would like to see. So it depends on exactly how this might play out.
Yeah.
But if that in fact were to be the situation, what you would see is there would be a lot more supply in longer dated paper, really meaning there's a lot more bonds at longer dates, and that would put upward pressure on prices because there'd just be a lot more of them, and then they would get reduced in value.
Yeah, there's a lot of wonky bond terminology in here. When we talk about maturities, you can also call that tenor. Basically, we're talking about when does this debt come due? So we talk about the 10-year yield, for instance. That is you're locking your money up for 10 years. So you pay the government $1,000. You get that $1,000 back after the 10 years. But in the meantime, you get what are called coupons. And from what I understand, they actually used to be coupons that you would clip. You take them into your bank and you get the interest payments. So the interest payments are coupons. So with that explanation, I'm not sure where I was going with that other than to explain a couple of things here. But when you talk to clients about bond markets and whether the bond market and whether bonds are suitable for somebody's portfolio, what are the dynamics that you look at?
Well, so of course the number one thing might be the yield. Is how much yield are you getting in your bond compared to what you could get elsewhere. So let's say your bond was yielding you something like 4.5%. Then if you're locking your money up in the bond, then you have to believe that that's going to be a better investment than putting your money in, say, stocks. And oftentimes is the case, especially in the last decade, you would get your bond return was quite low, so it made much more sense to put money into stocks. Now that bonds are at a much higher yield level, it makes potentially more sense to put your money into there because it's a less risky type of asset. Then the second thing to consider is the yield at which you're locking that in. Mm-hmm. So if you think that the yields are going to come down from here, it would make sense to lock at yields today, which is one thing that's kind of attractive today. Rates are fairly elevated at this point, so it kind of makes sense to lock in rates at this juncture.
And here's another thing. This is almost a personal finance question, but I hear it a lot. Why don't savings accounts rates kind of match what the Fed is doing? Like we're talking about these 4 or 5% rates. I get nothing like that in my main savings account. I have to hunt around and find something that's yielding north of 3%. So we don't always see those rates trickle down, even though you'd think these are short-term rates. But do you advise people to shop for rates, or how does that work?
Yeah, you might have to put your money into a mutual fund in order to capture those rates.
Like a money market fund, or?
Yeah, exactly, like a money market fund. And a big reason is because a lot of times banks don't necessarily have to sort of capitalize on all of those interest rate moves, so they don't necessarily have to raise rates quite in line with the Fed funds rate, which has been quite elevated. When banks do need to attract capital, that's when they would start raising their rates in order to attract people's money. But these days they don't necessarily have to do that in a big way, in which case you don't really get the same type of yield that you might get in other forms of sort of short interest
What
debt.
about like high yield savings account, right? That's
what
what
we're looking for. We just can't
Yeah.
find it. Like, where are the high yield savings account? Actually, we do have a personal finance section of the Yahoo Finance site, which is perfect for exploring these kinds of options. Brief little plug there. You know what it reminds me of, and this is going to be an interesting segue. It reminds me of the market for gasoline. So you see, like, there's an oil shock, and suddenly all the gas prices go higher immediately, even though they've had that gasoline in their big storage tanks for a while. But then it takes a long time for prices to come back down once that oil shock is over. We've seen crude oil, and here's where I'm going. We've seen crude oil kind of rise and pop a little bit, I think to $78 a barrel, WTI. How much is crude oil a concern from the inflation point of view? I haven't seen that on too many people's radars this year, but is that something you're even tracking?
Well, so energy prices tend to be quite volatile. And that's why when the Fed targets their official measure of inflation, they strip out food and energy prices. Not because they're not important, not because they're not something that the consumer has to pay for, but because they tend to be very volatile and not necessarily linked to things that are tied to what the Fed is doing. So because they're not really the official part of the Fed's target, it's less of a concern from a market's perspective, from an inflation perspective when I'm thinking about my forecast for the Fed for this year. That said, it is, of course, important. It is inflationary in a sense. But higher energy prices act as a tax on the consumer, similar to the way we talked about tariffs.
Sure.
So when the consumers have to pay a lot more for their energy prices, they might pull back on spending elsewhere, in which case it might be a bit self-fulfilling. It tends to sort of cap the way inflation might move, because that might just slow down the consumer in other pockets of the consumer's wallet.
We had a minute to break here. Sid, you were asking, we were talking about the consumer price index report that we got, and the food and energy prices, when you take those out, we actually saw a tick down in that number. It was kind of a surprise. Anything there in this latest inflation reading that gives you any solace as to what, like, I've been worried, I've been concerned about inflation picking back up, and now it's ticking down a little.
Yeah, so the inflation data that was reported most recently came in pretty good on average, right? So core inflation is the thing to pay attention to most when we're talking about the Fed. That came in quite modest. It was 0.225, which is a very good reading. The Fed is looking for something that rounds to 0.2, so this is a good one. And when it ties to the Fed's official measure, core PCE, it's looking like it should also come in kind of that 0.2. Food and energy prices, of course, were higher on a month-over-month basis, although they continue to slow down on a year-over-year. So it depends on how we're looking at it. The Fed these days, because they're really trying to figure out what their next move is, they're going to be focusing on the month-over-month data. And that's kind of what's going to be key for driving Fed policy in the next couple of months. The year-over-year number is important, but that's a little bit more slow-moving. So that is gradually coming down. But when we're thinking about Fed policy and what the market's really paying attention to, it's going to be that month-over-month reading.
Hold that thought. Perfect segue, because we're going to talk about the Fed in a minute. We need to take a short break. Coming up, we're going to talk about the dwindling number of Fed rate cuts this year as seen by the bond market and the derivatives market. And a power couple makes their way to the runway on today's Who Wore It Better? We are back. And this episode is brought to you by the number 3.93%. That is where derivatives and bond market investors see the Fed funds rate falling to by the end of the year, 2025. That translates into about 1.5 rate cuts, which makes it easier to follow along. We'd like to talk about 25 basis points or 0.25% rate cuts. And for context, the Fed, at its last meeting in December, it lowered its projection of rate cuts this year from 4 to 2. So maybe there's a little bit of agreement in there. Does it matter how many rate cuts, or is it the direction? What matters to you as an economist in terms of thinking about the Fed?
It matters the market's expectations for rate cuts over the next couple of years. So it's not just exactly what happens this year. The timing is a little bit less important because the market really thinks about, say, 2 or 10-year yields. So that's the average of the market's expectation for rates over the next either 2 or 10-year yields, plus the term premium. Don't have to get into that. But that's kind of why it matters over the next couple of years what the Fed can do, not necessarily exactly what month they're able to cut. And what tends to happen is when the Fed outlined what they're about to do, markets price it well in advance. So, you might find it to be surprising that 10-year yields are actually higher than where they were before the Fed started cutting in the first place in September of last year.
That's really interesting, and that's something I've been asking some other guests here. So when the Fed started cutting last September, so far they've cut 100 basis points. So short-term rates coming down by 100 basis points. Meantime, the 10-year, which we've been talking about quite a bit, shot up 100 basis points and maybe a little bit more since then. So that is something that really doesn't happen that often. And Torsten Slok, he's the Apollo chief global economist. By the way, that's our parent company. He says this hasn't happened before, going back to the 1980s. It kind of happened in 1998, which is an interesting situation. So what do you think about this? The long end coming down and the short end coming down and the long end being raised as the Fed finally cuts?
Yeah, it's definitely an interesting dynamic. I think a couple of things were at play here. One is certainly the election, right? The election had a notable impact on the long end of the yield. The reason is because investors are expecting the Fed is able to cut fewer times than would otherwise be the case. And then, of course, there's concerns about the deficit. And that all filters into this whole term premium concept, which is really just
We've broken that down a few times.
Okay,
Everybody
perfect.
Search your memory banks. We don't have to do that again.
Perfect. We don't want to get into that. Like, it can get quite wonky.
Yes.
But that's one reason why there's been upward pressure on yields since the Fed has started to cut. So it's a bit of a tightening of conditions, because the idea of the Fed cutting is they're trying to bring down interest rates across the curve so that consumers are able to finance their debt at a lower rate, companies too. So it's a bit of a sort of an interesting situation, because the Fed is cutting at the short end, yet it's more expensive to take out longer term debt. So probably not an ideal scenario, but the reason is because we have a president that may be more positive for the growth outlook, at least in the near term. That's what bond markets are telling you to some extent. And it's just the economy might be better off and able to handle higher interest rates than we previously thought.
Stephanie, what do you think about dissents we've seen at the Fed? I think we've had two, and they're pretty rare, right? So what do you think about them?
They've been surprising, right? So the first one
It was a Fed governor, I think there was a first
was Bowman,
one.
yeah. The first one was Fed Governor Bowman. That came partially because it was a large, jumbo rate cut. She didn't really agree with that.
The 50 basis points, which was a little controversial.
Exactly. Controversial 50 basis points. Now perhaps it's looking like it was a good dissent, because they probably didn't do 50 back in September. And then the second was Hammock, which was a bit of a surprise. People thought if it was going to be another dissent at the last meeting, it was going to be the same Fed governor who dissented in the first place. This time it wasn't. I think it's an indication that there's a lot of uncertainty with the Fed, and there's a lot of different sort of views about what should happen, and the discussions are getting pretty tense. So that would suggest, all else equal, there might be a little bit less movement out of the Fed this year, because there is not a real consensus with the governors.
It's really interesting. The Fed generally votes as a single block, and it's the job of the chair, and right now that's Jerome Powell, to kind of marshal everybody and get everybody on the same page. And when you get dissents, because it's rare, you kind of raise that little flag. And now potentially we have two going forward. We don't know, we don't know that it's going to happen, but potentially we have two. We were talking about rates. The long end of the yield curve ties into housing, and we've seen mortgage rates pretty high, locking people out of new housing. What do you think of the rates market right now? Home builder stocks, by the way, and we're not talking to you about stocks, but home builder stocks have been on a tear the last few days.
Yeah.
Just because rates are coming down.
Yeah, exactly. I mean, rates are good for the housing market. The challenge is mortgage rates are still kind of high for the broad-based housing market to do well. So now let's just say mortgage rates are in and around 7%. When we've looked at certain surveys that ask consumers, what rate would you be comfortable trading in your existing mortgage rate for something, for a new house, it was something in the low sixes. So we need a decent more rally in mortgage rates, or mortgage rates to come down, in order to really unlock the housing market. So right now it's been quite frozen, because if you have a mortgage rate that's something like 3.5%, which is the average effective mortgage rate,
which is pretty.
Far.
Yes, that's almost amazing to contemplate how low the payments are versus what people are facing now.
Exactly. So it's a hard trade, right? But if you get towards low sixes, people might now feel a little bit more comfortable to trade in their mortgage rate, because they want to move, or they want a bigger house, or whatever it is.
So is the R word, recession, at all in play this year? I feel like the economy is chugging along, but is there that risk at all?
There's never a 0% chance,
Yeah.
right? So on average, there's a 16% chance of
You know what
recession.
economists always say? It's 2 years away. It's 2 years away. It's 2 years away.
This time it might actually be,
Yeah,
right?
it might actually be 2 years away right now. We heard it from this economist.
Well, because we're also seeing like high-profile companies hiring freezes or slashing
Microsoft,
certain
yeah.
compensation.
So some big names,
Yeah.
Citigroup too, like pausing, adjusting their compensation, as Sid was saying. What I remember from 2022, those were the people who cut first, who cut jobs first, like big tech, and everybody saw these high-profile announcements, and they thought, okay, we're going to see all this recession taking place, but then it just didn't trickle down. And what we're seeing is kind of a resilient labor market, and we saw this in the jobs numbers last couple weeks ago. I'm just wondering, I don't think we hit really the labor market in that surprise payrolls report just yet.
Yeah, so a couple of things there, right? So the last couple of times we saw these waves of hiring freezes, we have to think about the time of the year. It tended to be around January. So the big announcements from a lot of these companies came at the start of the year that got a lot of folks worried about recession was coming, and then nothing played out, because this is normal business cycle type stuff, right? The beginning of the year, a lot of companies just think about their plans in terms of employment, and for some companies that might entail a hiring freeze. The thing that really hurts the labor market, though, is not just freezes, but big layoffs. And we haven't really seen that. Unemployment claims have remained very steady. And if business profit margins remain pretty good, there's not a big reason for layoffs. Companies were struggling to hire during the pandemic. And unless they really see a downward shift in terms of their profit margins, they're probably not going to do those big layoffs. And if we don't have layoffs, we don't have a recession.
All right, time is getting away from me, but we're going to make time for Who Wore It Better today. And we are looking at the ultimate power couple, fiscal and monetary stimulus, as they strut their stuff down the runway, both working together, by the way, to theoretically drive growth and stability. Now, amid the COVID outbreak in 2020, they joined forces. This is fiscal and monetary, delivering bazooka-level stimulus to the U.S. economy. Congress unleashed massive spending while the Fed pumped liquidity into Wall Street and Main Street, while also slashing interest rates. But in the teens or the 2010s, it was mostly monetary policy that was carrying the load. The Fed kept rates low, while Congress and the fiscal side, they stayed relatively quiet. And like any dynamic duo, they don't always agree. Fiscal loves bold upfront moves like stimulus packages, while monetary prefers steady behind-the-scenes adjustments like rate hikes. Most of the time, there are exceptions. So today, we're asking you, Stephanie, when it comes to managing the economy, who's wearing it better? Is it fiscal or monetary policy?
It's an interesting one. So for the past couple of years, they've been moving in opposite directions. The Fed was trying to tighten monetary policy, slow down the world, and fiscal policy was still quite stimulative. Some of it was lingering effect from the COVID pandemic. Now we're in a situation where they're more in line to some extent. The Fed is still easing, even though there are questions about how many times they might cut this year, if they cut at all. And fiscal policy may still be a little bit supportive. So I think the more important thing driving the economy at this point is probably going to be fiscal, because there's likely to be quite a bit of changes this year.
I think the message from the pandemic, we learned that fiscal is just much more powerful. Like the fiscal kind of outweighed a lot of the monetary stimulus maybe that the Fed did, or by comparison, if you look back to the global financial crisis, which had a fiscal component in the beginning, we didn't really see that extend. And so monetary policy with ZIRP and those lower interest rates, it just seemed like it was a never ending, it wasn't doing anything. So do you think we've moved past that point? Do you think that we're back to normal, or do you think we regress?
I mean, at least now the Fed has a higher buffer. So if they do need to cut rates in a big way, they have a much higher starting point than they did the last time. So that's
it only takes a few months to get to zero, though. We learned this.
That is fair, and hopefully that doesn't happen.
Yes.
But from a fiscal perspective, there could be a lot more that can be done. And also the economy is a little bit less interest rate sensitive than it used to be. So that's one reason why monetary policy was a little bit less impactful than would otherwise be the case.
All right, we're out of time. Can you believe it? Make sure you check out all our other episodes of Stocks in Translation on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms. And a special goodbye to you, Stephanie. Thank you for joining us here today. And we are signing off here at Stocks in Translation.